In January 2026, gold hit $5,595 per ounce, an all-time high. 1 month later, the United States and Israel launched strikes on Iran. The Strait of Hormuz was disrupted. Oil prices surged. Global uncertainty spiked to levels not seen since 2020. In every textbook, this is when gold goes up. War means uncertainty. Uncertainty means safety. Safety means gold. But gold didn't go up. It fell. By April, it dropped to roughly $4,722, a decline of over 15% during exactly the kind of crisis it's supposed to protect against. The safe haven failed. Understanding why it failed tells you more about how the modern financial system actually works than any bull market ever could. To understand why it failed, you need to understand why it normally works. Gold has been a crisis asset for thousands of years because it has no counterparty risk. A bond depends on a government paying you back. A stock depends on a company staying solvent. Cash depends on a central bank maintaining its value. Gold depends on nothing. It sits in a vault and doesn't care what happens to governments, companies, or currencies. In 1974, during the peak fallout of the OPEC oil embargo, gold rose 67%. During the 2008 financial crisis, gold rose while the S&P 500 fell nearly 39%. During COVID in 2020, gold hit what was then an all-time high of $2,075. The pattern was reliable for 50 years. Until now. The first reason gold failed is that the people who were supposed to be buying it were selling it. Central banks, especially in emerging markets, hold gold as a reserve asset. Turkey entered 2026 with roughly 614 tons of gold reserves. When the Iran conflict sent oil prices surging, Turkey's currency, the Lira, came under intense pressure. Oil is priced in dollars. A weaker Lira means more expensive oil imports. To defend the Lira, Turkey's central bank needed dollars. The fastest way to get dollars is to sell gold. In March alone, Turkey sold or swapped over 130 tons, roughly 21% of its total holdings. Turkey wasn't alone. Russia and Kazakhstan also reported liquidations to fund deficits or defend currencies. The buyers of last resort became sellers of necessity. The second reason is interest rates. Gold doesn't pay interest. It doesn't pay dividends. It just sits there. When interest rates are low, the opportunity cost of holding gold is small. You're not giving up much yield by choosing gold over bonds. When rates are high, the opportunity cost is painful. Going into 2026, markets were pricing in roughly 2.4 rate cuts by year-end, about 60 basis points of reduction. Lower rates would have made gold more attractive relative to bonds. That expectation was priced into gold's January high. Then the war changed everything. Oil prices surged. Energy costs spiked. By late March, the market had swung from expecting 2.4 cuts to pricing in a small chance of a rate hike. The Fed didn't just pause, the entire rate trajectory reversed. The 30-year Treasury yield climbed to 4.91%. Institutional investors, the ones who move billions, looked at the math and started selling gold to buy Treasuries yielding nearly 5%. The crisis that should have helped gold actually created the conditions that hurt it. When two forces push gold down at the same time, central bank selling and institutional portfolio rotation, you get what traders call a liquidation cascade. Falling prices trigger margin calls on leveraged gold positions. Margin calls force more selling. More selling pushes prices lower. Lower prices trigger more margin calls. The cascade feeds itself. Gold ETFs saw massive redemptions in March. CFTC data for the week of April 7 showed gross short positions rising to over 30,000 lots, a 5-month high. The very investors who had driven gold to $5,595 in January were now driving it below $4,722. The safe haven didn't fail because gold stopped being valuable. It failed because the specific conditions of this crisis created a dollar shortage and a rate shock simultaneously. Gold is still gold. But in a world where you need dollars to buy oil, and bonds pay nearly 5%, gold has competition it didn't have during previous crises. If you own gold, this doesn't mean you made a mistake. Gold is a long-term store of value, not a short-term trade. Over 20 years, gold has outperformed inflation consistently. The lesson here isn't gold is bad. The lesson is that the safe haven trade has conditions. It works when the crisis is contained and interest rates are falling. It fails when the crisis creates inflation that forces rates higher and creates a global dollar shortage that forces central banks to liquidate reserves. The 2026 Iran conflict is the first major geopolitical crisis in 50 years where all three conditions aligned against gold at once: inflation, rate expectations, and reserve liquidation. Some analysts view this as a temporary liquidity squeeze, not a fundamental change in gold's value. Others see it as evidence that in a world of 5% yields, gold's role has permanently shifted. Either way, understanding these mechanics is more valuable than any price prediction. Gold hit $5,595. A war started. Gold fell over 15%. The textbook said that shouldn't happen. But the textbook didn't account for a world where central banks need dollars more than they need gold, and where a war can simultaneously create the inflation that prevents rate cuts. The safe haven paradox. This is educational content, not financial advice.